Welcome, and thank you for watching this webinar on indirect costs for Continuum of Care Program and Emergency Solutions Grant Program funded projects. My name is Eli Hamilton, and I'm with Homebase. Homebase is a nonprofit that provides support to homeless systems of care across the country. In Santa Clara County, we work with the County Office of Supportive Housing to support the continuum of care with planning, facilitation, grant compliance, and best practices. As part of our work, we provide a series of free trainings each year for providers of housing and services that are operating in Santa Clara County. This training is going to, as I said, cover information about indirect costs for specifically federally funded CoC and ESG funded projects. This webinar will introduce the concepts of direct and indirect costs specifically related to those CoC and ESG funded programs. And we'll start with cost allowability, and then we'll discuss two ways that the federal guidance categorizes costs: direct versus indirect, and then facilities versus administrative costs. We'll then review several options for charging those indirect costs to a federal grant. This webinar will provide a high-level introduction to these concepts and will not review the entire scope of federal guidance or accounting best practices related to indirect costs. We used two primary resources to develop this webinar, and we strongly recommend reviewing both if you're interested in learning more or if you're making decisions about how to charge indirect costs for your organization's CoC or ESG funded projects. The first source is the Office of Management and Budget's Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. That's a long title, but these regulations are commonly known as the Uniform Guidance, and I'll refer to them as the Uniform Guidance during this presentation. The Uniform Guidance can be found in the Code of Federal Regulations at 2 CFR Part 200. The second source that we use is the Indirect Costs Toolkit for CoC and ESG programs, which I'll refer to as the toolkit during this presentation. This document was released by HUD in March 2021 and represents currently the most comprehensive source of CoC and ESG specific guidance on indirect costs. This toolkit is a great place to start learning more because it's very clearly organized and it references key uniform guidance sections. So first, let's go over the concept of cost allowability. The key point here is that all costs that you pay for with your federal grant must be allowable under both the uniform guidance and under the specific grant that you have. As we talk about cost allowability, remember that these guidelines apply to both direct and indirect costs. Under the uniform guidance, all costs paid for with federal funds must be reasonable, meaning it doesn't exceed what a reasonable person would pay under the same circumstances. It must also be necessary to the purpose and performance of the grant, and you must be able to allocate or tie directly the cost to the grant activities. Costs must also conform to any limitations or restrictions set forth in the uniform guidance and the specific program regulations. For example, the uniform guidance categorically prohibits the use of federal grant funds to pay for fundraising activities. There are other types of limitations and restrictions similar to that that you need to be aware of and avoid spending on those costs. Costs must also be consistent with you as the grantee, your internal policies and procedures. And another thing to note is when you're developing those policies and procedures, that specific types of costs have to be treated consistently across all of your federal grants, either as direct or indirect, but not switching between the two, direct or indirect, for the same type of cost under similar circumstances. Grantees must use generally accepted accounting principles to determine costs, with limited exceptions for non-federal government entities, but nonprofits are all expected to use generally accepted accounting principles. Grantees must not allocate the same cost to multiple federal grants. So we want to definitely very carefully avoid and track against double billing. All costs have to be documented. You have to be able to show documentation of the costs, and costs must be incurred during your approved budget period for that particular grant. For more detail on these cost allowability principles, check out that uniform guidance at 2 CFR 200. In addition to the uniform guidance principles of allowability, you must also ensure that all costs are eligible under the particular regulations that govern the funding program. For example, the ESG program interim rule governs ESG funded projects, and the CoC program interim rule governs CoC funded projects. Those regulations lay out allowable cost categories and grant activities in detail. Finally, you can only use your grant funds to reimburse costs that are included and allowable under your specific grant agreement. So we're looking at a 3-tiered structure of control over what you can spend your money on. It has to be allowable under the general federal uniform guidance. It has to be an allowable cost under your specific funding program regulations. And it also has to be a cost that you included in your grant budget when you applied for the funding. To illustrate this, here's an example of the types of costs that are allowed under specifically the CoC program interim rule. So if you are a CoC program grantee, all of your CoC grant expenditures must fall within one of these 6 eligible categories, whether they're expenditures that you treat as direct costs or those that are indirect costs. Further, you must check your grant agreement to determine which of these cost categories is included in your grant and in which amount. How much can you spend? You might have a grant with, say, rental assistance, supportive services, and administrative costs line items in it. Or alternatively, you might have a grant with administrative, leasing, and operating line items. The specific line items in your grant will determine the types of expenditures and activities you can cover with your grant funding. Now that we've established that all costs must be allowable, let's distinguish between direct and indirect costs. The language on this slide was pulled directly from sections of the uniform guidance that define these terms. So essentially, direct costs are those that you can clearly tie to your grant activities. You can tell how much the expenditure was and exactly which eligible participant and/or eligible activity of that grant it benefited. Indirect costs, on the other hand, are not as easily tied to a single grant or project. Indirect costs benefit multiple projects or funding streams, multiple, quote, cost objectives within your agency's operations. These are your costs that are shared across multiple projects. The uniform guidance does speak to the difficulty of establishing a bright line or very clear rule for determining whether a cost is direct or indirect. At 2 CFR Part 200.412, uniform guidance says, there is no universal rule for classifying certain costs as either direct or indirect under every accounting system. A cost may be direct with respect to some specific service or function, but indirect with respect to the federal award or other final cost objective. Therefore, it is essential that each item of cost incurred for the same purpose be treated consistently in like circumstances, either as a direct or an indirect cost, in order to avoid possible double charging of federal awards. The uniform guidance goes into more detail on the classification of specific types of costs as either direct or indirect in sections 200.420 through 200.476. So I recommend taking a look at those specific sections. While there is no one rule for classifying costs, I want to give you a few examples of costs that are very typically direct under CoC and ESG grants. Staff costs for case managers are a good illustration. Case management is provided to specific participants who are enrolled in a grant-funded project. Therefore, you should easily be able to document that your paid case manager, Diana, for 4 hours of case management for a client enrolled in your ESG program, as an example. If you have an ESG grant that includes funding for case management, you can get that 4 hours of case management reimbursed by HUD as a direct cost of your grant that is clearly benefiting that grant and only that grant. Rental assistance payments and client services paid for with grant funding are likewise typically easy to tie to a particular grant. On the other hand, you'll see that these common examples of indirect costs are more difficult to tie to a particular grant or project. If you purchase office furniture and supplies for general use in an office that supports multiple projects, it's not so easy to say that that particular chair is for CoC program X and this particular stapler is for ESG program Y. It's going to be used across projects. Similarly, some staff will perform tasks that support the activities of multiple projects, or that support agency operations generally. The same is often true of contracted services such as legal, accounting, and audit services. So you can see that these indirect cost examples support multiple, sometimes even all, of your projects and activities as an organization. That means that they can't be easily assigned to your federal grant, but it also means that they may very well be reasonable, necessary, and allowable costs of implementing that grant. The key is to fully understand your options for charging these indirect costs to your federal grant, and to do so in a way that complies with the uniform guidance and program regulations. Before we introduce some of those options for charging your indirect costs, let's discuss these two categories of indirect costs that are described in the uniform guidance: facilities costs and administration costs. The uniform guidance specifies that there are two categories of costs that can be considered indirect. In fact, the uniform guidance routinely refers to indirect costs as indirect, in parenthesis, F&A, facilities and administration costs. So under the facilities category, the guidance lists depreciation on buildings, equipment and capital improvement, interest on debt associated with certain buildings, equipment and capital improvements, and operations and maintenance expenses. For CoC and ESG grants, equipment, operating, and maintenance expenses are quite common facilities costs. This could include printers, cleaning services for an office space, office supplies, etc., that are used for multiple cost objectives. Under the administration category, the guidance lists general administration and general expenses such as the director's office, accounting, personnel, and all other types of expenditures not listed specifically under one of the subcategories of facilities. So the next question is, why is this distinction important? Why are we going into these definitions? First, one takeaway is that all indirect costs are either facilities or administration costs. But on the other hand, you may also have expenditures that fit into those descriptions and definitions of administrative cost or facilities costs that are not indirect, that are actually direct costs. So this highlights a key point. In this guidance, indirect and administration are not synonymous. You may have an administrative costs line item in your budget, and that line item is for both direct and indirect administrative costs. If you have expenditures that fall within the CoC or ESG administrative costs line item that's described in those program regulations, and you can directly track those expenses to your grant, you'll want to document and charge those to the grant as direct costs. On the other hand, you may also have indirect facilities costs, like the general office equipment that all your program staff use, that could be charged to other line items such as case management or even rental assistance. So the big takeaway here is all indirect costs are either facilities or administration, but not all administration or facilities costs are necessarily indirect. Now that we've covered some basic concepts for classifying costs, let's introduce some options for covering indirect costs related to your federal grant. As I mentioned at the beginning of the presentation, we won't cover all of the guidance related to these options. Our goal is to introduce the concepts and point you to further resources. We also strongly recommend that you work with an accounting professional who has experience with the federal uniform guidance. There are many details and practical consideration that we won't and really couldn't touch on in this video. So that said, the first option that we'll look at is the 10% de minimis rate. The de minimis rate is one of two options for using an indirect cost rate under a federal grant. Many federal grantees are able to use the de minimis rate, though it's important to note that there are limitations on who can use this option, which we'll cover in a few slides. The alternative to a de minimis rate would be to negotiate an indirect cost rate with the federal government, which we'll also cover in later slides. In its simplest form, an indirect cost rate, generally speaking, applies a predetermined rate or percentage to a predetermined set of direct costs to calculate an amount of indirect costs. That set of direct costs is called the direct cost base. The percentage used and the direct costs included in the base will depend on the specific approach that makes the most sense for a particular grantee, as allowed by the uniform guidance. So who can use the de minimis rate? The 10% de minimis rate is available to any nonprofit organization that has never had a negotiated indirect cost rate. If your nonprofit organization currently has or had in the past a negotiated rate, then you may not use the de minimis rate. Non-federal government entities, so meaning local government, state government, tribal government entities, may use the de minimis rate as well, as long as they don't receive more than $35 million total in direct federal funding across all federal funding sources. The de minimis rate uses a set 10% multiplier as the rate or percentage. It applies that rate to a direct cost base called the Modified Total Direct Costs, or MTDC. Modified total direct costs is defined in the uniform guidance and is further clarified for CoC and ESG program grantees in the toolkit. Under the uniform guidance, modified total direct costs include salaries and wages, fringe benefits, materials and supplies, services, travel, and up to the first $25,000 of each subaward or subcontract. The costs that comprise the MTDC for a grant are the documented allowable direct costs of that grant that fall within this definition. The uniform guidance also lists costs that are not and cannot be included in modified total direct costs. The list of excluded costs includes equipment, capital expenditures, charges for patient care, rental costs, tuition, scholarships and fellowships, participant support costs, subawards and contracts after $25,000, and other items as necessary to avoid serious inequity in the calculation of indirect costs. If you're still not clear as to which of your eligible direct costs make up the modified total direct costs for your CoC or ESG grant, don't worry too much. HUD's toolkit actually provides very specific guidance for both CoC and ESG grantees, clarifying which direct costs are included in MTDC for each eligible cost category under those funding programs. So we're not going to go over every included and excluded cost for ESG and CoC programs, but I do want to show you an example of the level of detail that the toolkit provides. This excerpt that you're seeing on this slide is from page 20 of the toolkit, and it shows specifically which continuum of care program rental assistance costs would be included in your modified total direct costs and which would be excluded. There's a similar table in the toolkit for each CoC program cost category and each ESG program cost category. To summarize, using the de minimis rate, your indirect costs would be equal to 10% of your modified total direct costs. Note that the total direct costs that you charge to your grant plus the total indirect costs you charge must be within your grant budget. Indirect costs never increase the grant amount that you're allowed to bill HUD for. If you want to use an indirect cost rate, your second option is to negotiate a rate. If you've had a negotiated rate in the past, or if you're a non-federal government entity that is a state, local, or tribal government entity, that receives at least $35 million in direct federal funding, this is your only option for an indirect cost rate. To establish a negotiated indirect cost rate, an entity must compile and submit an indirect cost rate proposal to their cognizant federal agency. Assembling an indirect cost rate proposal can be a pretty heavy lift. There's more information about what is included in a proposal, how to submit it, and the general review and approval process in HUD's toolkit. We also, again, strongly recommend working with an accounting professional who is familiar with the uniform guidance and with indirect cost rate proposals as you consider or move forward with this option. One relatively straightforward question is, who is your cognizant federal agency? Each grantee submits their indirect cost rate proposal to a federal agency, but which federal agency you submit to can vary. Typically, your cognizant agency is whichever agency provides the largest amount of direct federal funding to your organization as a whole. This may be HUD, or it may be another federal agency. Once a proposal has been submitted and approved, it's memorialized in a negotiated indirect cost rate agreement. This agreement, and therefore your indirect rate, will have an end date. At that point, you'll again need to go through the process of developing and submitting a proposal for review and approval if you want to continue using an indirect cost rate. You cannot revert to the de minimis rate, and negotiated rates will at some point need to be renewed and renegotiated. If you're considering using either the de minimis or a negotiated rate, you will need more information than what we just presented. These two resources, as I mentioned, are a good place to start. Appendix 4, Section C of the Uniform Guidance covers indirect cost rates in detail, and the toolkit provides CoC and ESG specific guidance from HUD. There is one final option for covering some of your indirect or shared costs, and that is to treat them as direct costs by allocating in accordance with the Uniform Guidance. The Uniform Guidance allows for grantees to allocate or prorate shared costs between multiple cost objectives, and then to charge the appropriate allocated amount to their federal grants as direct costs. For example, a phone service that's used by case managers across multiple projects might be allocated instead of being covered in an indirect cost rate. The methodology for allocating a particular cost must be consistent. So every time that cost is allocated, it's done using the same approach. You may use an indirect cost rate for some shared costs and direct cost allocation for others, and that's okay as long as you treat each type of cost consistently. The methodology you use to do direct cost allocation has to allocate actual costs rather than estimated or projected costs. In the case of a shared cost for a phone service, you'd need to take the total amount you actually paid for the cost of the phone service and allocate that amount across all of the projects that it's used for. The allocation methodology also needs to be closely tied to the actual benefit provided to each project or funding stream. Say you have case managers working on 3 different projects that all use this one phone service. And one project has about 80 clients, and the other 2 projects have about 10 clients each. It probably doesn't make sense to split that phone cost equally 3 ways, because it's likely that your case managers use the phone for your larger project a lot more. So you need to identify a reasonable basis for allocating that cost between the 3 projects that reflects the different amount of benefit, in this case, phone usage. For example, your case managers are already tracking their time, including the time spent working on each of those projects. So you could allocate that shared phone cost based on the percentage of your total case manager time spent on each of the 3 projects. That's likely to capture the different level of effort spent by case managers on each project, which is a good, reasonable basis for allocating that shared phone cost. A cost allocation plan is a key tool for documenting your plan for your shared or indirect costs. A cost allocation plan details how each type of cost incurred by your entity will be allocated to particular cost objectives, including federal grants. Regardless of the option or options you select, you want to pay for indirect costs with your, if you want to pay for indirect costs with your continuum of care or ESG grant funds, you must document your approach. It's essential to maintaining consistency and also to demonstrate to HUD that you understand and are complying with the uniform guidance and program regulations. Thanks again for watching this webinar. If you have any follow-up questions, feel free to reach out to Homebase at Santa Clara CoC at homebaseccc.org. We hope this basic information is helpful. As you implement your CoC and ESG grants, remember that this presentation didn't cover every detail or important piece of guidance, and each organization is in a different situation with different funding sources and expenditures. So a good next step is to review the uniform guidance and the toolkit and consult with an experienced accounting professional.